Welcome to DeFi by Design, where we talk all things blockchain and cryptocurrency while striving to educate, empower, and enrich.
It's your boy Andy, and welcome back to the DeFi Slate YouTube channel. Smash the like button on this video, that really helps us out, and sit back and enjoy the content. Thank you very much.
What's going on, guys? Welcome back to the DeFi by Design podcast, episode 93 in the books today with a crypto OG who has probably seen more pain than you could even imagine. And we're here today to talk about the state of things and what is going on in the world. So much has kind of happened in the last 2 months. Really, it's felt like an eternity. We're DeFi Slate, so we've been super DeFi focused this entire time. Always about, self custody and using these new products that come out. And I mean, we've had our fair share of rugs and our fair share of just crazy things. But I think that our kind of prophecy has started to lean to come true. But Mike might have a separate opinion on this, or might have a different opinion. So we're going to dive right into CeFi versus DeFi, what's going on with FTX and Binance, and kind of the evolution of what the space is going to look like over the coming years. So before we get it over to Mike, we'll say good morning to Rob, and good morning, Rob.
What is going on, Andy and Mike? It's a pleasure to be here with both of you guys. Yeah, I'm super stoked to talk to a Bitcoin and blockchain OG. We have Mike on the podcast today, and we're going to be talking about all things self-custody and otherwise, right? So we'll dive into kind of the recent gyrations of CeFi, how they've started to blend with traditional finance, and the future outlook of DeFi and self-custody, of Bitcoin and blockchain applications as a whole. I'm really stoked to talk to Mike about self-custody and the path that we can take to mass adoption of self-custody, if that's really in the best interest of individuals and the industry as a whole, and as well as touching on Wrap Bitcoin, as BitGo is the main CeFi to DeFi bridge of Wrap Bitcoin. I'm pretty excited to talk about that as well, and the custody solution that BitGo has built. So without further ado, Mike, good morning. How are you doing?
Good morning. Thanks for having me, guys. Great to chat with you.
Awesome.
It's always busy in this space. So we're gonna have a lot to talk about, and happy to take it any direction. I have been in the space a little longer than most. Back 2013 is when we got started. I guess I got interested in crypto a little bit before that. It was all Bitcoin back then. A lot has changed, and there's a lot more to change. I think DeFi has been a phenomenal innovation kind of 2018 and later. We did the Wrap Bitcoin product because we wanted to create a way that people could have the biggest value kind of operating on that network. I think it's run pretty well. Just did I think it was an 1.5-hour session with folks really poking at every risk of what goes into a product like that. Is a centralized custodial Wrap Bitcoin the way to do it? Should we be decentralized, et cetera? And just real quick, maybe clarify something. People think of BitGo these days, because we do this regulated custody, and that is what we're most known for. It takes a lot of heavy lifting in order to make that work, and we're regulated in multiple jurisdictions, and obviously some of the big institutional money comes through that venue. But we started in 2013 with 100% decentralization. It was a technology platform. My background is a technologist. I got excited about Bitcoin and what can this technology do to change the way finance works globally. So we innovated, we pioneered this early multi-sig component. It was buried inside of Bitcoin under this P2SH, pay to script hash feature that hadn't really been utilized very much up until then. And today we do 2 out of 3 multi-sig, we do 2 out of 3 MPC and threshold signatures, we do multiple blockchains, do all this stuff. But at our core, the technology is 100% this decentralized wallet as a service platform. And we pioneered that before anyone else was thinking about it. Anyway, I think that centralization in terms of holding custody through regulated parties is a necessary thing in terms of building out the whole ecosystem. We want to deliver trust in digital assets. We want to make it so that digital assets are ubiquitous, like whether you are an individual, whether you're a business, whether you are an existing TradFi bank, whatever, you are able to participate in digital assets. And so we think we have a big role there. But we do transcend across everything from completely DeFi, you hold it yourself, all the way through to centralized custody.
Very cool. Very cool. Yeah. And the proof of liabilities and reserves, I think, was one of the things that is like most timely at this point with kind of the runs on CeFi. And you guys have had that going on Wrap Bitcoin for quite a while now, which is telling that, it is truly transparent. You guys are firmly within the ethos of decentralization and the blockchain levels of transparency that it provides. I'm curious, kind of like going back to like how you first got involved. Could you tell us a little bit about like, kind of how the era has changed, with, what seems to be the new cycle kind of rising up, now through, we had DeFi summer, kind of like the entire yield farming cycle. And now we're kind of beginning this new cycle. What have you learned kind of across the eras that you're anticipating we see more of, and maybe, some things that we might see less of?
Well, let's see, right now we're just in the 30 days post the FTX collapse. So the ecosystem today, I don't know when people are watching this podcast, it could be years down the line, but the ecosystem today right now is reeling from that, and it's on everybody's mind. There's a pullback from centralized entities, like where is the next shoe going to drop? Who does not have all the assets that they claim they have? And so there's a huge focus in the industry as to who's solvent and who's not. It's great, actually, by the way, stress testing all of the different parts of our ecosystem. And there probably will be somebody that falls. And so proof of reserves has come up. But this isn't the first time. Unfortunately, we're humans, and we go through these very short-lived memory cycles. And one of my fears is that 3 or 4 weeks from now, we kind of all forget about FTX and what just happened, the lessons that we learned, the sting that we got, and we go back to business as usual, and don't really solve the problems. This has happened before. So back all the way to 2014, we had mt. And it's 8 years in bankruptcy. They still haven't distributed out to the creditors the results of that. That's a fascinating tale that's been well hashed, many times. Way back then, 2015, BitGo actually built first proof of reserve system that we had. We used it with a company called 𝗵𝗶𝗶𝗵. You probably don't remember 𝗵𝗶𝗶𝗵, but they were trying to do some micropayments of Bitcoin. They wanted to be able to make it go out to kind of Twitter type of users and other things. They're not around anymore, which is not relevant to the story. There were a few others that were also looking at proof of reserves, and 𝗵𝗶𝗵𝗵, who's one of the early Bitcoin developers, had come up with a mechanism for doing a proof of reserves, kind of in a Merkle tree. It's a complex cryptographic hashing tree where you can kind of demonstrate that balances exist inside of a larger balance. Now, proof of reserves is a good start, proving that you have assets behind it. But the problem that we have today is actually the ecosystem is more complex than it was back in 2014, 2015. That era really was kind of like, okay, we're dependent upon these services that are holding Bitcoins on our behalf. And by the way, BitGo was not even a custodian then. We were just a wallet platform. We didn't have any custody. But we're dependent on these folks that are holding assets. We're expecting them to hold them in reserve. Are they doing it? And that was a proof of reserve system that we launched. You can still see it in the news. But sure enough, it didn't take very long, 6 months. People kind of forgot about the sting of the hacks and whatnot, and they kind of moved on. And now in the wake of FTX, this is again alive and well. But today's markets are more complex in that not only do we have assets that you have to have on the books, which your users are expecting to see one-to-one, but we also know that there's been a tremendous amount of leverage in the system. There's been a tremendous amount of lending. People have not been forthright about what risks that they're taking in which entities. That's really the underpinnings of what happened with FTX. They were taking, they took all the money out and they put it inside of their prop trading hedge fund. And they didn't tell anybody that they did that. And you thought it was one-to-one reserve at FTX because that's what they told you. And that was a lie. So fortunately, Sam just went to jail yesterday for this. That is straight up fraud for sure. But in addition to proof of reserves, you also need to know proof of liabilities. And unfortunately, it's impossible to prove a negative. This is just a logical, conundrum. You can't prove that something doesn't exist easily. How do we do this in the traditional world? Well, we do it through audits. That's how we do it. We do it through regulatory oversight and audits. That's not a great system. I definitely hope that we can come up with something way better. Maybe the DeFi side will start to fix this problem over time. But we don't yet have, as a financial system of any kind, whether it's crypto, DeFi, traditional finance, anything other than audits to lean on. I suppose that does make a good segue to DeFi, but I talked a lot, so I'll hand it back to you.
Yeah, I mean, there's some really quality points there. First of all, obviously the FTX and kind of centralized exchange, centralized lenders at such a large scale are just not gonna work out. I mean, there's one thing to kind of, run a crypto fund or offer yields and kind of trade and do things, but when you're running an exchange where people are supposedly depositing their assets, it's a whole different kind of ball game than kind of some of these other things that we've seen. So yeah, definitely keen to kind of dive into how DeFi kind of comes into play here. But first, I'm curious more on your mental model and ideology towards DeFi. A lot of the Bitcoiners and OG kind of people who have been around for a while have seen all of the things. They've seen the ICOs and the master nodes and the passive incomes and all this. And then DeFi and yield farming. There's a small flock of people that kind of just insist that everything crypto is kind of a scam and a sham, and that everything Bitcoin is it. Now you've got the Bitcoin hat on, but I'm not going to put you in the camp of Ethereum is a scam. But I'm definitely curious if you think kind of Bitcoin is like the hard, solid money of the crypto ecosystem, and everything else is kind of a facade, or if you see some value in DeFi and Ethereum, specifically Ethereum, really, and kind of if you see a burgeoning world of NFTs and DAOs and DeFi, and if that's something that is realistic for the future, or you think that there's kind of just should be a solid focus on establishing Bitcoin as kind of this hard money of digital gold. Yeah, I'm curious what your kind of model is in your own head.
I'm a technologist, and I want to see innovation and technology go forward. And there's so many use cases we haven't even thought of yet that are going to be discovered as a result of the underpinnings that we're laying right now. So it's kind of like back in 1975, you had kind of early drafts of TCP/IP for connecting different internets together so that we could get the beginnings of networking, and then trying to envision like the web and what it's become today. There's just so much yet to be built. I am a huge fan of DeFi. So let's talk about the different parts of DeFi, though. I think you can break down the DeFi ecosystem into a few interesting things. One interesting innovation is actually that of stablecoins. So again, going back to like 2013, 2014, we weren't thinking about how do you put a dollar on this thing yet. We're thinking about how hard it was to get bank accounts and on-ramps to exchanges and other crypto service providers. And then along comes Tether and says, well, why don't we just consolidate the fiat capability over on this one place, and you can convert into Tether, and then you can put that as your digital side. Look, that's a huge innovation. Now, there's some challenges that we have to fix in terms of like, how do you do the proof of reserves on fiat? So we talked a little bit about that already, right? But you can prove the digital tokens when you have them. So wrap Bitcoin, which we do is a stable coin to Bitcoin. So we can see the number of tokens on chain. We can also see the number of Bitcoin on chain, and we can really do a good proof of reserves. With fiat, it's hard. But DeFi, I think, and stable coins, those are a real innovation that are going to be super helpful. I think we can get to purely digital markets and pull fiat out so that like our exchanges and our broker dealers, our clearinghouses are all digital, and the fiat is only handled on the side. And we use like a stable coin to manage, to isolate and contain the fiat piece. Then the rest of the system can be made incredibly transparent and can be made atomic, and can do all the digital things we want to do. So I think that's a huge innovation. I give that credit to DeFi, although I suppose to be truthful, Tether initially launched, I don't know if you remember this, way back on a thing called Omnicoin, which was a derivative of Mastercoin from back trying to build applications on top of Bitcoin. And Bitcoin smart contracting is not as sophisticated as Ethereum. Ethereum's way better here. All right, second area about DeFi that I think is really exciting. Look at the lending platforms and automated market makers that basically can replace financial services that exist in other industries. These are working really well. So although we've had all of these glitches with centralized lenders over the last 6 months, from Celsius to BlockFi, now to Sam, the DeFi markets have gone through this unscathed entirely. There is some risk, of course, on the DeFi markets. We make a lot of coding bugs in the software industry. This is not unique to crypto. So some of the smart contracts have had some flaws, but we're going to get through that. Those are one-time things that we figure out how to innovate through. And now, like, Compound is operating incredibly well. Now it's 100+% collateralized. It's auto liquidated. There's still an experimental piece of it, but I think this is showing incredible promise of replacing that piece of infrastructure. On the automated market maker side, again, same story. Like, you can get into liquidity pools that have got great depth to them. They're very transparent. They work very well. There's some things we're still figuring out about smart contracts that aren't perfect, but this is getting pretty promising. And then you mentioned like ICOs and other things. Look, one of the challenges we have with crypto assets is that we now have global access to things that look like money that go all the way out to retail in super easy ways. And really, this was created by, first we had the internet that connects all of us. We're all connected now. Information, we have not figured out how to mitigate truth from fiction, as what's going on with Twitter and all of the information wars not related to crypto. So this makes crypto potentially a venue for bad guys to fraudulently say, hey, this guy endorses this, that guy endorses this, could be great, whatever. In general, the yield farming, I've not been very interested in. I do think there will be some yields that are figured out, but yield farming of just like you're going to get some big return off of magic internet money, look, that's fake. It doesn't last. And we've seen a number of these collapse. We've seen lots of pumps and dump schemes. We've seen straight up rug pulls, Ponzi schemes. I think the challenge here is that it's global. Regulators aren't sure whose job it is. Regulators are a little bit baffled by there's so much of it they can't possibly keep up. And by the way, I don't think they should be blamed for that particular problem. All of a sudden, they're having to scale like Amazon, but they're regulators, and regulators have never been built for scale. Imagine having to track down 10,000 different projects where you got hundreds of them launching every day. They have a real challenge in front of them. So anyway, I am an absolutely huge fan of DeFi. You mentioned NFTs too. Let's just be clear there. I think digital property, I mean, again, fantastic innovation coming out of the back of the blockchain and what you can do. Actually, BitGo has a sub-brand called 𝗵𝗶𝗴𝗵, which is in late beta now, and it's going to be launching in January. So you can go to 𝗵𝗶𝗴𝗵.com. You can see it. Typically, BitGo is associated with institutional markets, so we put this out onto the onto a separate brand so it doesn't confuse like what we're about. The goal of that is to be a showcase app of all the stuff that you can build kind of on DeFi and Web3 using the BitGo APIs and the BitGo platform. Hopefully bring some security and safety to that industry, which is pretty early stage. I don't want to say weak. I mean, it's just an early stage, so it's not as robust. And we've done some NFT deals. We did an NFT deal with Nike, which we announced, I think, just about a month ago. So we're very big fans of what's happening with NFTs, and I think more broadly, digital asset property rights that can be fully online.
Yeah, we were talking to the founder of 𝗵𝗵𝗴𝗵𝗵 yesterday, and they're kind of blowing up. And he mentioned IP so many times, and it's just like that's it for NFTs. It's that kind of IP, that brand, that community. We've never really been able to have that online. Really, I mean, we've got like businesses online and websites, but to be able to own something like that and be able to use it for licensing and for different things where you can basically monetize the IP is pretty awesome. And I think Rob and I both agree on the points. AMMs and the over collateralized lending protocols in DeFi are pretty awesome. They've been very steadfast and have worked out quite well. And then of course on the contrary, the kind of over exaggerated Ponzi APRs is also kind of a facade. So I'm very curious about Wrap Bitcoin. I think Rob might have something as well, but just briefly, could you establish the prominence of Wrap Bitcoin, what it's backed by, and kind of reassure our audience that using Wrap Bitcoin in DeFi is legitimate, and of course not financial advice, but would like to kind of understand the why it's legitimate to be using that wrap token in particular.
Sure. And like I mentioned earlier, I just finished an 1.5-hour Twitter Spaces call with Chris Bleck.
Okay. You must have gotten hit pretty hard with some questions.
No, he's pretty reasonable. Look, like the community is kind of in charge of helping make sure that we're being really transparent about what's going on with these different systems. Not everybody is as transparent. And, I think all of us as community members are still learning like how to make sure we get the message out. So by the way, on Wrap Bitcoin, if you want to see some information, go to WBTC.network. Since its inception, we put out proof of reserves on Wrap Bitcoin. We put out a lot of documentation. We list who the parties are. There's a lot of complexity behind it. It still takes time to digest, but we are trying to be as transparent as possible. So real quick, dialing the clock back to 2018, DeFi's kind of taken off, but a lot of the value in the crypto ecosystem is behind Bitcoin. So kind of back to Bitcoin versus other assets. Where Bitcoin is great, the property that Bitcoin has that I think none of the other assets really have is the property of immutability. And if you want to have a value store, the one thing you need to know is that the rules of the value store are not going to change behind your back. You can't have the supply inflated. You can't have it controlled by any one party. It has to be resistant to adversaries from every angle. And that's what Bitcoin is focused on. So the core feature of Bitcoin is that it does not change. And that's what allows you to say, hey, you know what? I've got $100 million. I'm going to go put that into Bitcoin, and nobody's going to change the rules on me tomorrow. So I still have $100 million. And I know that Bitcoin's really volatile, but you understand what I mean. Like you can't have people changing the rules in addition to kind of the regular volatility that happens. So because of that, Bitcoin attracts, of course, the largest value store behind everything. And as we build up DeFi markets, people want to be able to use that value and participate now in some of these newer markets that are more experimental, on smart contracts, on newer technology, et cetera. So in 2018, along with a whole bunch of others, 𝗫𝗵𝗴 and a number of industry participants, we created a DAO and architected this model to take Wrap Bitcoin in a semi-decentralized, semi-centralized way, so that people could start to use Bitcoin value inside of DeFi and smart contracts. And we launched it for the first 1.5 years. By the way, it was really small. I think $1 million, $10 million. I mean, it's really quite small. And then all of a sudden, as DeFi started to hit its stride, it grew tremendously. So sometime last year it was $15 or $16 billion of size. It's the largest Bitcoin stablecoin in existence. As of right now, it's down to about 3 billion. Due to kind of what's going on with the normal market ups and downs. And so far, it's held perfectly fine. Actually, there's been in the post FTX world, there's been everybody fly off of everything centralized, and which is great. You hear exchanges saying it. I'm going to say it right here as well. If you're not using your Wrap Bitcoin, you shouldn't be holding it, right? If you're using it within a DeFi project, of course, you need it. You're using it. But as soon as you're done with it, get rid of it, right? Send it back, and it will get burned back, and it will get released back as Bitcoin. That's happened. So in the last 4 weeks, I think we've seen the total size of Wrap Bitcoin drop from about 280,000 Bitcoins down to around 200,000 Bitcoins. Again, it's all on that WBTC.network. So with the system we created, BitGo does act as the custodian. We are not the owner of Wrap Bitcoin. That's owned by the DAO. We don't control the DAO. We can't burn your tokens or anything like that. All we do is the custody and the mints and burns. We don't own the smart contract. We do hold in one-to-one reserves. We hold proof of reserves for that. And when people come and ask us to burn it, we burn it and distribute it back. So I think we've been pretty reliable on that. And it's held through all tests over the last 4 weeks.
Yeah, there was a shock to the system after that FTX collapse. Alameda had their hands in Ren Bitcoin, and then that caused some confusion. And I personally was doing some due diligence. I discovered the Wrap Bitcoin proof of reserves, and I realized this is the most comprehensive reserve and liability proofing mechanism that I had seen from any central custodian exchange or otherwise. And it just kind of reassured my belief that wrapped Bitcoin is not only solvent, but liquid, transparent, and functional for its purpose on Ethereum and decentralized money markets, which was really, really encouraging. I totally align with your topology that you laid out in decentralized finance and how wrapped Bitcoin fits into that. And I think we painted a really interesting mental model of how the decentralized ecosystem is functioning with all of the what we might consider new primitives, but ultimately kind of a recreation of traditional finance. There's been plenty of Ponzi schemes and rug pulls and so on and so forth that have kind of made their way onto decentralized chains. And what we've realized is, if it didn't work or if it was illegal in traditional finance, it's also not going to work and be illegal in decentralized finance. So we're not really recreating the wheel in that sense. We're just kind of bringing what does work and making it better with these newer and more efficient technologies, and kind of continuing that thread of the new technologies that are exciting and interesting that we're seeing arise. I'm curious how you see cryptocurrency and blockchain fitting into maybe some other technologies that we haven't seen enter the ecosystem yet, like AI and ChatGPT have been getting tons of attention. And just as a technologist, do you see cryptocurrency interweaving with those other pieces? How do you see the combinatorics of like the newer technologies emerging and combining with one another to create like this future of the internet?
Yeah, well, let's see. Responding a little bit to what you're saying and then talking about the future. I think when it comes to money, people get ahead of ourselves a little bit, seeking big yields. We're building a new financial system here, and we need to build kind of block by block and build it up. Remember the existing financial system, which I think is terrible. It could be way better, but it's been built up over decades. In fact, hundreds of years, and it's established over a very, very slow period of time. Crypto has emerged incredibly quickly and is still evolving. And we really need to kind of build the basics before we can get to the advanced features. So, when you talk about all the different bad things that can happen out there, one of the basic ones is like a rug pull. And you don't tend to hear about rug pulls in the traditional the traditional financial system. And kind of have mostly figured that out. I'm not saying it doesn't happen, it does. But can we just solve that one, please? I think as soon as we get it into crypto, that the base layer, we're not going to be subject to basic rug pulls, then I think we can start talking about some of the more advanced topics. There's a bunch of new problems we have to figure out to solve. Like, how do we do great auditing of smart contracts so that as new projects come out, we can count on them or ease into them in a responsible way. But if we've got basic rug pulls that are still happening, we're going to continue to have events like what's happened with Sam Bankman-Fried here. So I think we're getting there to some degree, but I think this is going to be a cooperation among, community, industry, and regulatory. And then when I say regulatory, that's not just US, it's like global regulatory. And regulators have never had to solve things kind of at a global level before. And by the way, I don't even know how to do that. That's an incredibly tough problem. What we see here with FTX is operating out of Bahamas, and now you've got some disputes between the two different locales as to like what should have happened or not happened here. And if we end up with a world where companies can kind of just disconnect into the most lenient regulatory system, we're still going to have some rug pulls. And all right, so maybe this is going to mean some more monetary education for the users of it. But let's switch to the future side that you're talking about. The fact is that money and software are intersecting, and they're going to intersect in every single industry that we have. And I think NFTs are a great example of this. So let me give a little background of how did BitGo go from decentralized wallet platform to custodian, and why? And then it's actually the exact same thing that's happening now with NFTs. So, we started out with this decentralized notion. We got a grassroots industry that's wanting to be able to, not your keys, not your coins. We build these decentralized wallets. They've got multi-sig capability for security. People like that. Great. They start to use it in businesses. Well, as we get deeper and deeper into businesses, around 2016, we signed up CME Group. If you're not familiar with them, the largest commodities derivatives exchange, in the United States and in the world. And they were working on a strategic project. So they were able to work with us, even though we still weren't regulated in any way. But they weren't alone. What was happening is businesses were starting to get to the point where they wanted to participate in digital assets. And these are fiduciaries. These are guys like they're holding money for, maybe it's a hedge fund, maybe it's an RIA. It could be a lot of different cases, but they're like, I can't hold the keys myself. If I accidentally screw up, forget about, malfeasance. If I screw up and lose these keys, I'm going to be held as a fiduciary. I'm never going to be able to get a job again. So the smart guy said, look, we need to have somebody that can hold custody of these assets in a regulatory safe way. BitGo responded. Initially, we had thought that existing custodians and banks would take on this role, but it was too difficult for them at that time. So we built BitGo Trust Company to take on that function. And of course, that helped the industry, by the way, grow, because now all of a sudden fiduciaries could participate. And previously, they really couldn't do it in a responsible way. And those fiduciaries care about, okay, how are you regulated? Are you abiding by sanctions and BSA and AML/KYC? What backstops you have, like insurance? What technology do you have? Who's the management team? How do I know I'm not going to get rug pulled? What risks am I taking? That's what they want to generally know. Now, let's come all the way forward. I'm going to skip a bunch of things, come into NFTs. We've now got big corporates that are really excited about building customer loyalty programs, ecosystems, communities like Nike, like Disney, et cetera. And what they're really interested, of course, is engaging with their own customers and their ecosystems. And they get really excited about what they can do with digital property rights and be able to, create new innovative products. And they get about 3 steps in and their attorneys come in and they're like, wait. These are going to go into markets. These NFTs can sell for money. Like, this could be a lot of money. Is this money transmission? Wait, what happens if we lose the keys? Like, what is our responsibility to our customers now that this is overlapping with money? It's actually the exact same conversation that we were having back in 2016 as fiduciaries were trying to figure out how to deal with digital assets. Now that's happening at the corporate level with NFTs. And so it's an example, finally answering your question, of money just intersecting with software. And this is going to happen in taxi cabs, right? Where the taxi cab is going to be directly interfacing with money. This is going to happen on every website. Today you use this credit card system, which, it actually works fairly well. Surprising how rickety the overall system is, but it does work. But you're going to have money straight in your computer. You'll be able to make payments direct without having to go through intermediaries. And there's going to be much, much more to come. So we are definitely in a new era of finance where money intersects everything.
Yeah, that takes fintech, to a whole new level. Financial technology, right? Is,
Well, this means you hear about money transmission a fair amount in the crypto spaces. It's probably not something you heard about, prior to crypto. And why is this? Before that, you hear about banks. You probably don't know what's the difference in a bank and a custodian. Kind of the financial system that exists around us, pre-crypto. A lot of it has been built. Mostly retail doesn't have to know how it works. You might have a brokerage account. You sort of understand that that's the place where you trade stocks. But what responsibilities, what connectivity does it have to the exchanges? How does that clear and settle? How am I guaranteed I'm going to get what I'm supposed to get? It was built over so much time and so long ago that we don't think about those things. And all of a sudden, all of this is being thrust into the forefront, with crypto, where we don't have a lot of these pieces. And it turns out that the subtlety between a custodian and a bank is actually pretty important. And what protections do you get or not get? So again, people are getting a little bit overexcited about the monetary possibilities. Is causing these big spikes and run-ups where we're going, I think, frankly, too quickly in terms of offering it out. And people are getting excited about yields and things, but they don't understand. All right, but building the building blocks, we'll get there. And then, money is intersecting with everything we do. Money transmission as a concept, which has previously been something that banks had to worry about, now becomes wait, all these service providers and every type of software has to worry about it. Regulators also need to think about this. Do they want to be regulating, taxi cabs taking payments? No, not really. That's a payment. And yet, because of the way, it works, it's certainly going to collide with the existing rules where it could be classified as money transmission. So these are all being figured out right now, and it's going to be a big overhaul.
Yeah, this intersection of money and software is kind of creating a world where money is as transferable as information. And, the information ecosystem was built, using the internet, where we had kind of like the Web 1 era. And that was just kind of like, the readability of it, not really the writability to the internet. And now, fast forward Web 1 to Web 2, there was, I think of Wikipedia or email where we can transfer information, just as easily as, pressing a button and sending it over the internet. And now money is taking on the form of simply like monetary information. And it has all the same capabilities and transferabilities as information, just with the fact that people value it.
That's right. And, all data has some amount of value. And now that you can move that around and maintain ownership of it, that has monetary properties. It may not be currency like issued by the government, but it very much is money. And when you look at money transmission laws, you'll see different definitions of money, by the way, in every state. A lot of commonality, but there's some differences. And there's the notion of money and monetary value. So once you make it so that digital property can be sent around, which does have value, well, it's monetary value. So much like if you tried to pay for something with potato chips, let's say you wanted to buy a car with potato chips, it'd be a lot of potato chips, but technically you could do it. And that does hit money transmission laws if you've done it. It just happens to be so impractical and stupid, nobody would do that. But now all of a sudden with digital assets, okay, well now any two parties can decide to engage in a transaction where these things can have monetary value, and you start doing that as a business, that starts to hit money transmission laws.
Yeah, and this reminds me of a podcast I was listening to recently. It was the Network State with Belshe, and he kind of paints this picture of commoditizing our identity through the transferability of that data. That data has value. Right now, I've heard arguments that Facebook, Twitter, social media companies are kind of ripping off that data from ourselves, since we willingly give it to these social media companies, and then they go and commoditize it by selling it to advertisers and receiving some fiat for it. When we commoditize that data like a bag of potato chips, the lines between what's money and what isn't money are really starting to blur between money. Traditionally, as we know, currency, information, and data all have transferable value over the internet.
That's right. And, Balaji's amazing. He's such a deep thinker, and he's gotten to a level of abstraction that, I find hard to keep up with, but he's been, spot on so many different topics around how things are evolving. I do think, some of the futuristic things about how reputation becomes critical to our future world, pseudonymity becomes critical to our future world, and data ownership comes back, and we become much more self-sovereign. All of those concepts, he explores at a very deep level. And he's right; it's coming. I tend to operate a little bit more in the here and now. We have a business to run. We got to, we've got to, make revenues, and we also have to move the industry forward. We also have design goals, which is like, we really want to see a better monetary system, and we've got parts of it in play now, where all of us can participate, and we can go head to head with banks and financial institutions, and that's a new concept we haven't had before. We have the ability to go global. That's a new concept we haven't really had before. And now we need to figure out how to refine that and eliminate risk so that people don't get just rug pulled and ripped off.
Yeah, that's kind of a good segue into onboarding the next, user base. Like BitGo has done a great job of providing the foundation for what we have currently to exist. And now we're going to be able to have continuous onboarding, right, from 2013, 2014, right, all the way up till now, which is 2023 almost. And I imagine the next 5 to 8 years are probably the biggest onboarding years in terms of mass adoption that we'll see in crypto, right? Like, you can only mass adopt everybody kind of once in a sense, like, it kind of just happens and then it's done. And I think that's kind of the next 5 to 8 years or so is probably that time. So I'm curious, like, what do you think is like the ideal route for a newcomer to kind of join crypto? And I'm saying this on the back end of a few kind of contradictory ways to hold your keys, which is that ledgers and treasures are good, but you have to protect your keys and your safes and your metal keys, and you gotta separate them, and you gotta figure out how to, if something happens to you, who gets your keys, and how to make sure that they don't steal them before you get them, and how do you hold them, and then how do you travel with it, all these things. And then you've got the centralized exchange route, which is much more kind of out of your individual control, but obviously, as we've seen this year. So the question here is self-custody for newcomers, or kind of centralized exchange, or kind of splitting on across. I guess what I'm really trying to get at is, like, how do people kind of protect themselves from just the security risks of crypto, especially new people who may not be so savvy with everything?
Sure. Well, look, one of the side effects of having the ability to self-custody is that we now have to think about security in ways we didn't have to think about it before. So I guess I think there's two things everyone should do. Number one, only invest in assets that you understand. If you don't understand the asset, if you don't understand why it has a yield or whatever, you should probably think twice about like why you're dealing with it. And it may mean that you're on the sidelines of the greatest, run up in history, but it's probably the smart call. Then second, in terms of security, I think it's going to depend for everyone on what's the value of what they're securing. So just to use some analogies, you have a wallet on your presence right now. You probably have some small amount of cash in it. I don't know, maybe it's $200, maybe it's $50. You're probably not worried about losing that because relative to your overall assets, it's small. Sure, you could lose it. Sure, you could get mugged, but it's not a concern. But you don't take all of your assets and put it into your pocket in your wallet. And if you did, you would obviously take much more care. Now, by the way, what's a large amount is an individual decision, right? What $1 million might be nothing to Elon Musk, but to all of the folks here listening to this call, that's a lot of money. We care about it, right? We want to make sure we don't lose it. We want to make sure we can pass it on to our family. Should something unfortunate happen to us, through natural causes or whatever, we want to make sure that we're not putting ourselves at physical risk to be mugged or robbed, etc. So there's this principle in crypto, which is not your keys, not your coins. I completely agree with this statement. Obviously, if you hold the actual value, it's yours, and it's yours alone, and nobody can get between you and that money, hopefully. And if you put it somewhere else, then basically you've given it to somebody, you've entrusted someone else to take care of it for you, and they've given you some sort of an IOU. And if you can't trust that party and they rug pull you, or they take it, they lose it accidentally, whatever, your IOU is worthless, and now you lost all your money. So look, you say, okay, I'm going to take it on my own, and then I'll be better off. I think today, because we haven't built enough market structure and forced everyone to use it, there's too many rickety parties out there, which is causing this constant, like, not your keys, not your coins, not your keys, not your coins. But if we take this out on some time horizon, then it gets to a different world. Let's imagine, we are all onboarded, right? We all have crypto. If 90% of your assets, your net worth, were in crypto, or hey, 100% of your net worth was in crypto, would you want to hold it yourself? Some people would say yes, and some people on a technological level are certainly capable of that and can. Other people would say no. At some level, you get to, like, how do you protect yourself from physical attacks? What happens if someone comes in, puts a gun to your head, and says, give me all of your life savings? Do you want to have a safe in your house, bars on your windows, security guards, gun? I don't know. Some people would say yes, other people would say no. So this is where, like, all of a sudden, the ability for us to be the sovereign owners of our own assets creates a new set of security questions we simply haven't had to deal with for a very long time. Now, by the way, the emergence of banks, if you go back to the 1800s and, why did people start using banks and how did they start trusting banks? And I'm not a perfect historian here, but I think you look at the emergence of those banks, there's a lot of trust issues. Like, why is the bank going to disappear? Is it going to be here tomorrow? Is it going to take my money? I'll bet you there were plenty of rug pulls in those early days too. It's just that we're beyond that. By the way, do you know why banks tend to have like these big marble pillars and like these big, very kind of old-fashioned styles when you walk into them?
It reminds me of like a Greek kind of like, like the Parthenon or something like that. Like it's just like that kind of protection vibe.
The reason is because you walk in and it's permanent. Like the bank can't set up shop and temporarily put a bunch of expensive marble there. No, like if you put in, these big expensive marble, furnishings and all that, then that can't just be moved. It's expensive to put there. It demonstrates a commitment to be there. And also it can't be taken away easily. It's all about building trust. And that kind of goes to the same thing of like, how did a bank in those early days convince people that it wasn't going to be open today and then tomorrow you go there and nobody's there and your money's gone? It was part of building trust in those early days. So we're past that now. All right. So for onboarding of people today, again, look, you got to understand the risks of what you're taking. You got to be comfortable with the level of risk that you're taking. So if you put all of your net worth into it, you are taking a lot of risk. And there's the risk at the software level, at the blockchain level. I would not say that Bitcoin or Ethereum or anything is fully done and guaranteed never to have a failure. I think those are relatively unlikely and getting better all the time. But DeFi projects, of course, have their own risks. Which custodial partners are behind it? What is the regulatory behind that? All right, so I'm not really giving you a great answer, except to maybe make sure that people getting into the space need to have a healthy dose of like what are the risks, and make sure that they're mitigating those risks appropriately. And over time, as we go deeper, as an ecosystem, as regulators, as politicians, others, we need to continue to make it safer and whatnot. Now, just to make sure it's not all doom and gloom, given the monetary system that we have in front of us, given what's going on at the Fed with massive 10 trillion of money printing over the last couple of years, I believe it's irresponsible for anyone in America not to have 3 to 5% of the net worth in crypto right now, and that probably means Bitcoin. But it could mean Ethereum and other things. And that means you have to answer this question of who can you trust? And so you either take self-custody, which means you have to have an element of technical acumen. That means like if you want to protect yourself from physical theft, you have to think about how you're going to do backups. Handing it off to your kids, you have to think about that. Having a fire at your house, you have to think about that. You need offsite backups. These are hard things for most people to do, and they get lazy and they tend not to do it. If you're ready to do that, the technology is all here. You buy yourself a ledger, you're good to go. If you're not ready to do that, you need to find where you're going to put it. And look, I think the answer is simple. You go to the regulated entities. Look, regulated entities are going to see a different caliber of service. We have this at BitGo. The management team is known. We've got insurance backups. We've got regulatory licenses that require us to operate in certain ways. Coinbase is another good example for retail. That can work well. We do have solutions here. But I think it's not as simple a question as just not your keys, not your coins for most people, if you're talking about anything other than money that you don't mind completely losing.
Got it. Yeah, I agree. It's a good point. The regulated exchanges are definitely there and exist. So why not use them? And then, the ledgers are great. So, Mike, I really appreciate you coming on and representing BitGo as the founder and CEO. Commend you for the work. Also appreciate Wrap Bitcoin. It's been great. And any kind of closing thoughts from you?
Well, I think actually some of the risks we talk about in the post FTX, people get a little bit downer kind of thing. So I apologize for taking it that way, but that's about highlighting the risks. Look, on the opportunity side, this idea that money is intersecting everything, I hope people find that exciting. I think it's why people should be participating. And there's just so much more coming that's going to change our lives and eventually be everywhere. So I hope everybody is not discouraged and instead digs in, get yourself educated. You get a fascinating ride through why is money the way money is? And on the other side of it, you get a way healthier financial future.
Cheers, man. Thank you.
All right.
It's a pleasure, Mike. Thanks for coming on.